Hey, welcome to my channel. I'm Charlie's Money, and today we're going to be reacting to how to read a stock chart and find buy points with US investing champion David Ryan. I haven't seen this video yet, so I'll watch the video, pause it, and make comments. I learned about David Ryan from the book Market Wizards by Jack D. Schwager, and I was pleasantly surprised by how he was heavily inspired by William O'Neill in his investing strategy. I hold William O'Neill in very high regards and am testing multiple aspects of his investing, but David Ryan took this a step further because not only was he obsessed with William O'Neill, but he also ended up working for him, and then went on to win 3 US investing championships with a compounded return of 1,379%. His annual returns were 161%, 160%, and 118% from 1985 to 1987. Something to note is that David Ryan doesn't seem to be running any funds, and after looking for a bit, I haven't found any information on how much David Ryan is worth or how much money he manages today. It doesn't necessarily mean anything, he could be just very private, but it could also mean that his strategy only maybe works for smaller amounts of money. By the way, if you want to learn more about different professionals' investing strategies, I created a course called How to Invest Like Warren Buffett. It's a detailed analysis of Warren Buffett's investing strategies and top investments to try and understand the strategies and reasoning behind his success. You can also learn more about my investing strategy on my Patreon account, where I go through market insights on a daily or semi-daily basis. Thanks for watching. Please like and subscribe, and let's get into the video. Thanks to TraderLion for making this video. Go check out their channel and subscribe.
First thing I do is I look to see, and you can see the different trend lines I've put on here. I look to see, first of all, is the stock in an uptrend? Is it close to its high?
Is it in an uptrend, and is it at a new high? This is a characteristic that David Ryan and William O'Neill share, which makes them very different from value investors like Warren Buffett. Because instead of trying to find undervalued stocks that are turning around that are near their lows, these guys look for stocks that are making new highs so that they can catch it at the beginning of a major move. And that way they don't waste time trying to catch a falling knife or holding a stock that goes nowhere. In fact, William O'Neill called this the great stock market paradox because in a study he did, he found that the stocks that seemed too high tended to go higher, and the stocks that seemed too low tend to go lower. One of the logics for buying at new price highs is because you don't get resistance from the people that are underwater on their purchase. Because let's say a weaker investor bought here and saw his price go down for the following 3 months, if he doesn't get rid of his purchase with other weaker investors here, he might be inclined to do so once his previous losses were recouped here. But if you buy at a new price high, there's less resistance from those underwater positions.
And then I focus in, is it, okay, now is it extended? This one this has only gone sideways for a couple of weeks. So I actually like to see longer bases. I mean, this is a better buy situation right here, where the stock's been in an uptrend, goes back and forth for 5 or 6 weeks, and then it comes through. To me, I like the longer buy points better than these short bases because I think short bases usually get short moves out of.
So David Ryan talks about long consolidation base from 5 to 6 weeks, and then it comes through, and that with short bases you get shorter moves. This is another concept that William O'Neill talked about, where a stock needs to make a base before it breaks out. The consolidation base typically gets rid of weaker investors and accumulates the stronger investors who will cause the stock to break out. Typically, this means that the stock stays between a defined high and a defined low for a period of time. David Ryan says he likes to look for bases that are from 5 to 6 weeks, but William O'Neill talked about them being up to a year or more. This actually has a lot of similarities to Nicholas Darvis's box theory, where he would watch a stock that was consolidating after making a big price run and showing strong price action. David Ryan talks about the longer the base in length, the stronger the breakout. That's because the longer there's accumulation, the stronger buyers can come in, like institutions. It means that the stock has found a more stable price level where buyers are coming in, and it's like compressing a string where the move will be stronger when it finally breaks out. Since the long base is longer, it also gets rid of the weaker investors, and that's because since the base was longer, the weaker investors got out, and it only leaves in the stronger investors who won't sell easily during the breakout. Which is like a rally of only diamond hands people.
And so, but I first focus on, I'm always just looking over here, and within a few seconds I can say if I'm going to spend any more time with this stock. Let me just, I'll bring up randomly. Here's IBM. Okay, gap down, bad relative strength. I don't have to spend more than a fraction of a second on that saying it's gone. I don't want to look at that. let's see, DuPont, 37 relative strength, downtrend, no. So, okay, here's a better one. AMD. Okay, AMD, yes, this has been a strong stock. It's been an uptrend. Okay, but now I look at this and I go, okay, well, it should have been bought somewhere down in here, where the majority of the base was. It's up here. It's extended. I think it looks strong. I guess they have earnings in a day. That's another thing I don't want to buy right before earnings. It's extended. I'll put that. I click this button. I put it into my data monitor, and so.
He's talking about a couple things here. First of all, he's saying how easily he can tell if a stock looks interesting or not based on whether it's making new price highs. Advanced 6 was, so it's worthy of more analysis. On the other hand, IBM and DuPont aren't, and so that's already a negative point against them. On top of that, David Ryan is using investors.com charts, which come with a relative strength rating. The IBD relative strength rating looks at a stock's performance over the last year and ranks it from 1 to 99. So a stock with a relative strength of 99 means that it's performing better than the rest of the market, and 1 meaning that it's underperforming the market. Here IBM has a relative strength rating of 28, which means that it's performing on the lower end of the scale, and DuPont is at 37. So with those two pieces of information, the relative strength is low and it's not making new highs. David Ryan is already able to say, this is not interesting, I don't want to look at this. When he makes it to AMD, he sees that, oh, the stock does look like it's making a new price high. You can see it also has a relative strength of 89, which means that it's a potentially strong candidate. However, David Ryan points out a caveat to his investing in new highs strategy, which is that it has to be a certain percentage from the base for it to look attractive. Looking at AMD, he can see that it's already extended about 10% away from its base, and as a result, there's a higher risk that it will come right back down. David Ryan uses IBD religiously. I'm pretty sure he used a Swing Trader to get those charts. Feel free to check it out.
Somewhere down in here, where the majority of the base was, it's up here, it's extended. I think it looks strong. I guess they have earnings in a day. That's another thing I don't want to buy right before earnings. It's extended. I'll put that. I click this button. I put it into my data monitor, and so.
On top of that, here he notices that the stock has its earnings coming up, and he explains that he wouldn't buy a stock near its earnings, and that's because unexpected earnings results coming in can cause extreme volatility in a stock, and that can potentially cause big losses if a stock drops on bad news or weak guidance. Earnings can often be seen as a coin flip because the stock could have great earnings and yet the stock goes down, or vice versa, the stock has terrible earnings but the stock keeps going up. And it's not uncommon even for mega cap stocks to go up or down 20% after earnings. He talks about adding that stock to his list so that he can watch it potentially in the future if it has better action. And he does that by adding it to his list on IBD because it could be a potentially interesting stock to him because it's making new highs, but he was too late in this one, so he needs to wait to buy it potentially at a later time.
Should spend any more time on it. And then once, let's say I find something, let's see, I look at something that's got a nice longer base on it. Okay, this is about a 5 or 6 week base on it. Nice uptrend.
So now, once he trimmed out the stocks that he didn't like, he looks at a stock that has a longer base and that could potentially be a good investment based on his previous characteristics.
The group is not in a great group, but if they ever pass infrastructure, then this company will do well. I've done well in the past on this stock a few different times.
So here he just talks about group trend and how it has to pass infrastructure. He's specifically talking about this group relative strength rating, which is C-. This is another feature of IBD where they categorize stocks into industry groups and then rank them based on overall performance, price actions, earnings growth, and other key metrics. A higher industry score means that it's generally outperforming other industries. Both Jesse Livermore and Nicholas Darvis also did this because they always made sure that their stock was in a strong, booming industry group. In this case, David Ryan is saying that this stock on its own is looking good, but it's missing a key ingredient because other stocks in that industry need to also be doing well. If that's the only stock in the industry that's doing well, it might not be enough to push the stocks of the entire industry.
But then from there, I go to I say that the chart looks good. Now it looks like it's breaking out, but then I go to the earnings down here. All those look good. Then I go to the weekly.
So after looking at the price action on a stock that he says he's done well in the past with, he looks at the earnings growth. Here you can see that the earnings growth was 43% versus the same quarter in the previous year. Here's 77%, 31%, and 23%. In the Market Wizard interview, David Ryan mentioned that he liked looking for stocks that had the last 2 quarters of earnings growth that were above 15%, so that ticks that box, and then the last 5 years earnings growth above 50%. Here, 3 out of 4 of the earnings were above 50%, so that would be a positive sign for the earnings growth.
And I like to see are the institutions, the institutions actually have dropped in the last couple of quarters, so that's not a good sign.
So here he looks at the institutional investors, which is another characteristic that William O'Neill gave a lot of value to. And ideally, you want to look for a stock that more and more institutions are buying, because institutional buying is really what drives the largest stock moves. In this case, the number of institutions has been on a downtrend since this first quarter here. So David Ryan sees that as not a great sign because he would want to see them increasing.
And then what kind of growth rate? 28% growth rate. So I just start going through the CanSlim characteristics, but it all starts with looking at the uptrend and the consolidation of the stock.
And then he looks at the earnings growth rate, which is what I mentioned earlier. So his analysis starts with looking at the charts and then goes into looking at the fundamentals. And only then does he start to dive more into the characteristics of the stock. In the Market Wizard interview, David Ryan talks about going through 4,000 charts a week. He writes down all the ones that have strong price action and then looks further into them.
So just to kind of summarize what you're saying, you're looking for a strong uptrend, and then within a base, you're looking for price tightness. Is that kind of what you're looking for very quickly?
Yeah.
Okay.
Why is this guy's audio so laggy?
Price tightness. Is that kind of what you're looking for? A strong uptrend, and then within a base, you're looking for price tightness. Is that kind of what you're looking for?
I didn't hear the price tightness part. I didn't hear him mention tight price. I heard him talk about consolidation and breaking out, but I didn't hear him talk about price tightness. So Richard Morgan, the commentator from Trader Lion here, is talking about price tightness, which I didn't hear David Ryan mention the word tightness once. Price tightness just means that the trading range is narrowing with smaller price swings, and that can be a bullish sign during consolidation because there's less selling pressure before a potential breakout. In this case, his tightness is this, not this. But to me, this is not tightness. That is tightness right here. Or like, this is tight. This is tightness, but that's not always a good sign. This little thing right here is tightness. This like 3-day, 5-day, whatever, that's tightness.
Yeah.
And I think it's really interesting. I've heard you say this a few times. You're looking for a breakout through the majority of the base. Basically, it doesn't have to be the high of the base, which is kind of the standard pivot. So could you talk a little bit about that, kind of any alternate buy points that you use, or consolidation pivots, that type of thing, to get in a little bit earlier than the true breakout?
Yeah, I mean, for something like this, I mean, the high at this point was 101.96. But if I take this and I try to make it so simple. And this, I think, has helped a lot of people. I just say, draw the line, find where the majority of the base was built under. And that's where your buy point is. So many people, they're looking for cups and handles. They're looking for double bottoms, triple bottoms. They're looking for pocket pivots. They're looking for low cheats, high cheats, mid cheats. They're looking for all these things. And I just say, look, don't make it complicated. Just draw the line over the majority of the base. And I'm saying like 90% of the base. And that's probably where your best buy point is. Yes, you can look for lower areas, but I would say that's only for people who are more advanced to look at these buy points, because you still have overhead supply on these things that are lower down in the base.
Right.
And I just don't know if those work as well as something that's a little, higher in the base and still has all the different characteristics, like 90% of the.
So Richard Moglen is asking about finding an indicator that's earlier in the base, or something that he could potentially get a day trading algorithm to find maybe. And David Ryan's response is that there are a million different techniques like that, but he doesn't like them as much. He draws a line on the chart and decides that this is the best level to get in at. The reason he picks the previous high in particular is because all of this zone has buyers that bought at a higher price and are potentially trying to get out of their stock or recoup their losses. Those are the weaker investors that will limit the upside momentum. They're like trapped sellers that are waiting for the price to go past their buy point so that they can recoup their losses. And as a result, that causes resistance from previous buyers. If there are too many weaker investors and the consolidation is too long, it could drive the stock to go down. And that's why David Ryan likes the higher entry point, because here he knows that it's gotten rid of potentially all of the weaker investors. He has a higher degree of certainty that people who held up to this point have a lower probability of selling once the stock price rises. I thought this video was great. David Ryan's analysis was very clear. I'm surprised he didn't talk about volume at all. He didn't even mention it when he was looking at stocks that he liked. But yeah, thanks again for watching, and please like and subscribe, and see you in the next one.